With fewer than 100 days to go until the November election, President Obama and Governor Romney spent today campaigning in battleground states, trading barbs on taxes and the economy. For the president and his Republican challenger, the day's stage was a pair of key states, and the intended audience, the middle class. Mitt Romney stumped in Golden, Colorado, his first campaign event since returning from a week-long overseas trip. Romney argued again that the president's policies have failed the middle class.
Now, I know he will be able to speak eloquently and describe all the great things he's doing and what he's going to do, but look at the results. And you look at the results, and it's been a disappointment. His policies have not worked. They have not got America back to work again. I understand that it's small businesses that create jobs in America, that people create jobs, not government, and I'm going to get America working again.
The Romney campaign also went up with a new television ad highlighting economic troubles in Florida ahead of the president's visit there today.
But under President Obama, 8.6% unemployment, record foreclosures, 600,000 more Floridians in poverty. He focused on Obamacare instead of jobs. Barack Obama, what a disappointment.
The Obama campaign countered with its own new ad. It attacked Romney for paying just 14% of his income in taxes in 2010 and charged his tax reform proposal favors the rich.
Now he has a plan that would give millionaires another tax break and raises taxes on middle-class families by up to $2,000 a year. Mitt Romney's middle-class tax increase. He pays less, you pay more.
The president hit that same theme during an event this afternoon in Orlando.
They have tried to sell us this trickle-down tax cut fairy dust before. And guess what? It didn't work then. It will not work now. It's not a plan to create jobs. It is not a plan to reduce the deficit. It is not a plan to build our middle class. It is not a plan to move our economy forward.
Mr. Obama again highlighted a study by the Nonpartisan Tax Policy Center that concluded Romney's proposal would provide large tax cuts to high-income households and increase the tax burdens on middle and or lower-income taxpayers. But Eric Fernstrom, a top Romney advisor, called the report, quote, a joke, and raised questions about its impartiality and methodology.
Good to see you. Hi there, how are you?
The sharpened debate on tax fairness underscores the importance both campaigns have placed on middle-class voters. A recent NBC News Wall Street Journal poll gave Mr. Obama a 16-point lead on Romney when it comes to who would better look out for the middle class. For a closer look at what exactly is in the Romney tax proposal at the heart of this political fight, we turn to Bill Gale of the Tax Policy Center. He's a co-author of the report in question. And Scott Hodge of the also nonpartisan Tax Foundation. He has a different read on the Romney plan. And gentlemen, we thank you both for being with us.
Thank you. Thank you.
So, Bill Gale, to you first, just quickly, how do you respond to the Romney advisor who called this assessment a joke and he questioned its impartiality and methodology?
Well, first thing, let's be clear, that's a shoot the messenger kind of answer. If they had a substantive response to our analysis, I presume that they would make a substantive response. Last fall, when we put out an analysis of the other Republican candidates' tax options, the Romney campaign liked our analysis a lot, said very nice things about us. So it seems like their opinion of us depends on whether we're reporting on what they do or what someone else does.
Well, Bill Gale, let me ask you, what in a nutshell did the Tax Policy Center conclude about where the tax burden falls, assuming the Romney plan were enacted, tax plan?
Thank you. We did a very straightforward exercise. We said Governor Romney wants to cut rates by 20%. He doesn't want to raise the rate on capital gains or dividends or other saving investments, but he wants his reform to be revenue neutral. That means you have to raise the revenue somewhere else. We took the most optimistic way, the most progressive way to raise that revenue. And we showed that even under those circumstances, there would be a big tax cut for high-income households and a tax increase for middle-income households.
That's boiling it down to a great degree. But
yes, and what I want to emphasize is it's a matter of arithmetic. It's not some incredibly fancy calculation. It's simply that if you cut tax rates for high-income households, you lose so much revenue there that you can't make it up by shutting down the tax exemptions that high-income households have.
So, Scott Hodge, what do you make of this analysis from the Tax Center?
Well, I think you have to be fair that what Bill and Brookings have done is, I think, a pretty reasonable assessment. But you have to understand that it is not an analysis of the Romney plan. The Romney has only set out some very, very broad parameters of what he would do in terms of tax policy, in terms of cutting the individual rates, all of them by 20%, cutting the corporate rate by 10 percentage points. But what Brookings did was actually fill in a lot of this unknowns with their own assumptions and then analyzed it. So this is not technically an analysis of the Romney plan. It is one option for how to get from here to there. There are many ways in which Romney could fill out the details of his plan. They, of course, are not forthcoming with that because they'd like to keep it to a big picture approach. So we have to be very careful about reading too much into this.
Well, let me just stop you.
It really is not the Romney plan.
All right. So filling in a lot of assumptions.
Well, let me respond to that. It's correct that Governor Romney has not specified all the details of his tax reform plan. He's specified the goodies, the tax cuts, but he's not specified how he will pay for them. If he would do so,
he may not even pay for them. He may decide that we're going to scrap revenue neutrality.
Well, he has said he wants it to be revenue neutral. So
revenue neutral meaning money is not raised.
Exactly.
That taxes are not raised.
Meaning on net, the average tax cut is zero. So we took the options that he said he wanted, and then when we filled in how to pay for that, we did that in a way that fills it in most by taxing high-income households. Okay, so if Romney wants to finance his tax cuts with spending cuts, that's going to be even more regressive because spending cuts go largely to low and middle-income households. So we made what is the most optimistic assumptions in the filling in part, and still came out to the conclusion that I mentioned.
What about that explanation?
Well, one of the most interesting aspects of the study is that it really confirms how progressive our current income tax system is. And what the study unfortunately doesn't show is that about half of all Americans pay no income taxes whatsoever, and the vast majority of income taxes are paid by the top. In fact, a recent CBO study shows that the top 20% of taxpayers pays 94% of all income taxes. And so they're correct. It's mathematically impossible to cut all tax rates without somewhat benefiting the rich, because the rich are the only ones paying income taxes. Meanwhile, we have half of all Americans paying no income taxes whatsoever and benefiting from about $100 billion in refundable tax credits, even though they pay no income taxes. So we're going to have a big decision here on tax reform. Do we put some of those non-payers back on the tax rolls, and how many should avoid paying taxes? What
more information would you have needed, Bill Gale, in order to make a fuller, a more complete analysis of the Romney plan?
Well, the governor would simply have to specify how he wanted to pay for the rate cuts that he wants. He has specified that he doesn't want to raise dividend and capital gains tax rates, but he hasn't specified any other way of paying for the tax cuts.
And what's your sense of why he hasn't done that?
Well, because the more details you put out there, the more room that you have for others to shoot holes in it. And I think what he wants to do, and I'm not a surrogate for the Romney camp by any means, I think what they're trying to do is stay to the big picture and talk about the bigger issues here, and that their belief is that when you cut marginal tax rates, you see economic growth. And they have a lot of research behind their belief in that, and I think that that's the message that they're trying to push.
Does that show up in your analysis?
We do have some behavioral responses, and we did analysis allowing a growth effect. The growth effects of revenue-neutral tax reform can be vastly overstated. Congressional Budget Office Joint Committee on Taxation have done analysis showing relatively small effects. In 1986, We had a big revenue neutral tax reform. We didn't get a big growth effect out of that. And the answer is because the reason why is that essentially the average marginal tax rate doesn't end up changing that much in a revenue neutral reform.
Respond to that.
Well, there are lots of ways to get from here to there, and if you design it in one way, you're going to get poor results. If you design it in a more pro-growth manner, you can get vastly better outcomes.
Bill Gale, do you at the Tax Policy Center plan to do an assessment of the Obama tax reform plan?
We have done assessments of the President's budget every year when it comes out. In fact, assessments that are much more detailed and extensive than this particular paper that came out yesterday. We've done estimates of the Republicans' candidates' tax reform plans. We will continue to estimate anything we can get our hands on, basically.
All right, we are going to leave it there. Scott Hodge, we thank you very much with the Tax Foundation. Bill Gale with the Tax Policy Center. Gentlemen, thank you.
Thank you.
And you can watch both candidates in action on the campaign trail today. We posted their full speeches on our politics page.